accounting circle.
Me as Chitra, I will present our book of original entry.
I am Shuni. I will present about the ledger.
I'm Misha Jeremy. I will present about adjustment.
Hi, I am Izzati. I'm going to present about the source of the human.
Hi, I'm Inen. I'm going to present about tribal.
I am Tenjawe. I am going to present about soul chains of
Identify the step of accounting cycle. The accounting cycle is a process of recording business transactions which involve variety of steps in a certain period of time. The accounting cycle shows a step of recording and collecting business information evenly and systematically so that the financial statement and report can be analyzed and presented to the management.
Hi, I am going to present about a source document. A source document is a document in which data collected for a clinical trial is first recorded. This data is usually later entered in the case report form. The International Conference of Harmonization of Technical Requirement of Registration of Pharmaceuticals for Human Use is a guidance defines source document as original document data and record. Source document contains source data which is defined as all information in original records and certified copies of original records of clinical findings, observation or other activity in a clinical trial necessary for the reconstruction and evaluation of the trial. Next, I'm going to expand about the example of source document. First is hospital record. Second is clinical and office chart. Third is laboratory notes. Fourth is memorandum. Fifth is subject diaries or evaluation checklist. Next, pharmacy dispensing record. Then recorded data from automate instrument. Okay, that's all from me.
I will present about book of original entry. General journal is a day book or journal which is used to record transaction relating to adjustment entry, opening stock, accounting error. The sources document of this entry book are journal voucher, copy of management, and invoice. It is where double entry bookkeeping entry are recorded by debiting one or more account and crediting another one or more account with the same total amount. The total debited and the total amount credited should always be equal, thereby ensuring the account equation is maintained. In accounting and bookkeeping, a journal is a record of finances transaction in order by date. A journal is also the book of original entry from where transactions were written in a journal prior to manually posting them to the account in the general ledger or subsidiary ledger. Manual system usually have a variety of journals such as sales journal, purchase journal, cash receipt journal, cash deduction journal, and a general journal. Depending on the business accounting information system, specially journal may be used in conjunction with the general journal for record keeping. In such case, use of the general journal may be limited to non-routine and adjustment entry. General journal entry included the date of the transaction, the title of the account debited and credited, the amount of each debit of each debit and credit, and an explanation of the transaction, also known as a narration.
A ledger account contains a record of business transaction. It is a separate record within the general ledger that is assigned to a specific asset, liability, equity item, revenue type, or expenses type. Example of ledger accounts are cash, account receivable, inventory, fixed asset, account payable, accrued expenses, debt, stockholder equity, revenue, cost of goods sold, salaries and wage, office expenses, depreciation, and income tax expenses.
So, now I'm going to talk about trial balance. A trial balance is a list of all the general ledger account, both revenue and capital contained in a ledger of a business. This list will contain the name of each nominal ledger account and the value of that nominal ledger balance. Each nominal ledger account will hold either a debit balance or a credit balance. The debit balance value will be listed in the debit column of the trial balance, and the credit value balance will be listed in the credit column. The trading profit and loss statement and balance sheet and other financial report can then be produced using the ledger accounts list on the same balance. That's all from me.
Such transactions are usually entered in a module of the accounting software that is specifically designed for it and which generates an accounting entry on behalf of the user. However, if such transactions have not yet been recorded as of the end of an accounting period, or if the entry incorrectly states the impact of the transaction, the accounting staff make accounting adjustments in the form of adjusting entries. These adjustments are designed to bring the company's report financial results into compliance with the dicta of the relevant accounting framework, such as generally accepted accounting principles, international financial reporting standards. The adjustments are primarily used under the accrual basic of accounting. Examples of such accounting adjustments are recognizing revenue that has not been billed, recognizing expenses for supplier invoice that has not yet been received. Then the last one is recording prepaid expenses as expenses. So that's all from me. Thank you.
I am going to present about Sophie and Sophie. The first is company title, and the next is statement of comprehensive income for the years that ended 31 December 2008. The next step is sales less sales return. We will get net sales. And the second is cost of sales is opening inventory, purchase, and less purchase return. Carriage inward is including duty on purchase, insurance on purchase, cost of goods available for sales, and less closing inventory, and we will get gross profit or loss. For the revenue, at discount received, rent received, commission received, interest received, and we will get the total revenue. The last is operating expenses. Less salary and wages, insurance, printing and stationery, rent expenses, allow interest expenses, repair expenses, carriage outward, and we will get the operating expenses. Gross profit plus the revenue and minus expenses, and we will get the net profit. Next is Sophie. The first is company title, and the next is statement of financial positions as at 31 December 2000 X2. The next step is non-current asset. Then non-current asset is land and building, fixture and fittings, and office equipment, machinery, and motor vehicle. Second, current asset. Current asset is closing inventory, account receivable, less allowance for doubtful debt, and cash and bank, cash in hand, repair expenses, accrued revenue. The financial right is owner equity, is capital, add net profit, less drawings, and get capital. For non-current liability is long-term loan plus mortgage on premise. Last is current liabilities is including loan, bank overdraft, account payable, accrued expenses, revenue received in advance. Lastly, the total Sochi must be balanced with total Sophie. So that's all from me.